Now, from the preliminary offers to the closing of a deal, what is involved with that? How do we work this packaging deal from offers to closing? That's what we're going to talk about in the second part of a real-life example of the sale of a business. I'm Arthur Petropoulos, managing partner of Hillview Partners. We're a middle market, low middle market, M&A, capital advisory, investment banking firm, helping companies generating roughly $1 million to $10 million in pre-tax earnings or EBITDA, sell their businesses or secure capital. So the packaging deal that we were talking about in the last video, I suggest anyone else to check out that video. We'll put a snapshot of it somewhere in the screen here. We'd gone from the initial outreach and materials preparation through the collection of offers for the business. Now we have the matrix of offers that we've presented to our client, showing again value, structure, transition, stakeholders, and we say, okay, let's further synthesize this. We need to find the optimal singular party. Now, how do we do that? And so we discuss with our client what some of the offers look like. And there's always going to be a bit of a bell curve, and so some of the outliers, again, we're just going to say no to because it's a little too far out. But nonetheless, we talk to our client about what the most important elements are, how they're feeling about any of these particular parties, if it's people that they're somewhat aware of, financial situations. With financial buyers, oftentimes it's not, but with strategics, it can certainly be the case. And then we go back to all of the different parties and we iterate and we talk to different people and we see just how good we can get some of these terms. Because in an ideal scenario, you don't want to be trading value for structure, trading transition for stakeholders. You really want to find a party that can optimize all of the variables. And if done correctly, which it was in this situation, we were able to do so, where valuation, structure, transition, and stakeholder considerations were all what we deemed to be the best for the party we ultimately went with. But that being said, before we get ahead of ourselves, our goal is to chop that 15 down and put kind of 10 on the back burner and find the 5 optimal at that case. And at that point, we set up meetings with ownership. And we set up a Zoom meeting with the prospective buyer and ownership. And this is a part of business that, because there's just a lack of familiarity with how these processes work, ownership will say, well, how is this going to work? And how do we manage this appropriately? But really, it's a process that we facilitate. So we get on the Zoom meetings, we have the prospective acquirers introduce themselves, tell us what they're about, and then we have our client do the same thing, and then we open the floor for questions. But largely, this is a mutual evaluation. Just as much as we are selling a company, an acquirer is selling our client on the idea of them being the acquirer. And so it's not the Seville inquisitions, if you will. It's much more of a conversation and a dialogue. And we are not bringing our clients to Attila the Hun. The acquirers that we are working with understand and want to be partners in the business, in the future growth of the business. Even if they're acquiring the totality of it, the majority of it, they still want to see the ongoing success of the business. And that's a calming function, if you will, for our clients. That these are not people looking to come in and destroy the business. They're people that are looking to take it to the next level and build on the legacy that's already been established. And so we have, say, 5 of these hour or so meetings. And after that, we then confer with our client again and what did you think of these and how did you think of this? And then we go back to these 5 parties and again try to kind of work the terms in the optimal direction. And some people are going to say, hey, this is just the best I can do. I've already said it. Others say, look, maybe if we tweak this, we can do it this way. But the idea is at that point to secure what we deem to be the optimal party. Now, there are instances, and it wasn't in this case. In this case, we had one singular party that we thought was a bit head and shoulders above some of the others, but in other situations there can be a further dialogue, almost like another round, if you will, of maybe 2 parties, sometimes 3. But usually we're able to kind of say, hey, this is the optimal party we'd like to move forward with. And so at this point, call it day 100 or so, we're signing a letter of intent. And so this letter of intent is a document that says company is going to acquire other company upon these terms with this contemplated time period. Again, the diligence period that we're going to be entering, and these are the rights of both parties. And typically it's going to say there's a 60 or 90-day time period from which the acquirer is going to evaluate the business and the seller is going to effectively evaluate the acquirer. Now we're entering into the diligence period, which we call the confirmatory diligence period, that allows the acquirer to confirm all of their assumptions that led up to their offer, and similarly allows the seller to confirm everything they believe to be true about the acquirer. Now we pound the table with acquirers that when we're entering diligence, it's not an evaluative period. It's not to see if they really like the business. It's really their opportunity to just check for landmines, to make sure that there's no surprises, that everything is as represented. But again, it's not to say, ooh, do I really want to do this? But rather to say, okay, we do really want to do this before we get into diligence. And now it's just a matter of crossing T's and dotting I's and making sure everything that's been told to be in the box is actually there. So that's largely going to take 3 different sub-processes followed up by the definitive documentation. So we entered into diligence in this situation. You'll largely always have, and in this case we did, a quality of earnings. And so that is basically an outside accounting firm that comes in, that looks through all of the documents. Now this is the point where they look at the tax returns, the bank statements, the things like that, to make sure it all ties back neatly to the financials that they've predicated their offer on. Secondly, there's going to be a legal/insurance diligence where they want to review all of the insurance policies. They want to review all the contracts. They want to review all the vendor agreements to make sure there's no lingering risk there that they haven't contemplated. And third, in this case was a lighter touch, but we call it a specialist diligence. And so in a software company, for instance, they'll send in somebody to review the code and to look at it from that perspective. In this particular instance, there was a packaging specialist that they had sent in to come and evaluate that some of the processes in accordance with their understanding of how the industry worked. And so again, not evaluative, but confirmatory to make sure there were no anomalies in the process. And that was a particularly light touch in this business. Now, in this case, it was a 90-day diligence process because there was a lot of physical stuff, warehouses, inventory, things of that nature. When it tends to be more physical businesses, that diligence can be a touch longer than some of the more, call it digital, whether it's an e-commerce or software or a business like that. But that being said, 60 to 90 days is still fairly the norm. In this case, and in many cases, when you get towards kind of the back quarter to a third of the diligence exercise, that is when the buyer, and it's the onus of the buyer, provides what's called the definitive documentation. That is going to be the purchase and sale agreement, any consulting agreements, things of that nature. Now you might say to yourself, well, like, hey, I bought a house or I bought commercial real estate before and we signed a purchase and sale agreement and then had the effective diligence period prior to the closing. Now, that's a little bit different in, call it the real estate world versus the operating company world. And so in the operating company world, actually, it's the letter of intent that begins the diligence period that is then completed with the purchase and sale agreement being signed effectively at the closing, coterminous with funds being transferred. And so what's interesting is kind of an observation from our side is that although a real estate agreement starts with a purchase and sale agreement and then has an inspection period, if you will, although it would seem that it's starting with a more formal document, we actually see a lot more, I've historically heard of it and seen a lot more from friends in other industries, more real estate deals fall apart than necessarily M&A deals, because I think there's a real emphasis on our side that we're not going to enter into a diligence period with someone unless we know it's purely a confirmatory exercise. And so in 150 deals, if we've had 5 that have kind of fallen apart in the diligence process, that would be a lot. And so it's an interesting observation, but the point being is in case you're just talking cadence of deals and people are always going to say as a comparable, just because it's a more, I guess, commonly understood or known or talked about thing, is like, hey, when I bought the building, they did the purchase and sale agreement first, not after. That's what's a little bit different in the corporate transaction world. But nonetheless, we got the definitive documentation in that case from the acquirer. We reviewed it. It iterated between lawyers a few times. And just about at the 6-month mark, all parties came together and effectively like a closing, but in this case, remotely for some parties and not for others. The transaction was closed and funded, and the transition began to take place. And so the operations of the business and the transition period in this business was contemplated to be, I believe it was 3 to 6 months based on the acquirer's need. And so effectively the day after the closing, the business kind of just continued on as normal. Accounts had been transferred over accordingly such that the dollars and cents were going in the right direction, but the funds were received at the closing by the seller. The acquirer had all of the legal documents in escrow and everything go back to them, and the business continued forward. And so we may, in a different video, talk about kind of post-transaction existence and how that operates and real-life examples of that. But we wanted to walk through, in this week's videos, an actual example of selling a company. So specialized packaging company that made $2 to $3 million a year in EBITDA, sold for north of 6 times EBITDA with a good structure, with an optimized transition period, with an optimized treatment of stakeholders in a 6-month exercise from which we had 200 parties that we had initial dialogues with, in excess of 200 parties, over 50 signed NDAs, north of 15 preliminary offers that yielded 5 further dialogues and meetings that yielded 1 optimal party that yielded or progressed through in this case, I think it was an 80-day diligence process, hitting the QOV, the quality of earnings, the legal review, small, light touch, specialized diligence, and then progressing through the definitive documentation. So while the totality of the exercise of selling a business can seem like an overwhelming thing to contemplate, it's truly just the aggregation of a lot of small things that, if done well, yields very good results. We were just chatting with a company last week who's contemplating selling their business, and they said, we have all of these concerns about the prospect of selling our business or finding a strategic partner. And the ultimate conclusion of the conversation, and what I'd said to them somewhat jokingly, was all of these things you're worried about, if you do it the wrong way, they're all going to happen. And it's true. We've seen horror stories, and it tends to be that when corporate transactions take the wrong path, the results are far worse than, say, a real estate or a home transaction that goes the wrong way, because there's less of a hard asset and it's more of a broader machine, if you will, a business oftentimes, than purely just a real estate asset. And secondly, however, we say when done right, all of these pain points or these pitfalls can be avoided. And that's the good part of it, and that's the value that we bring to a situation. And so, not to sell our own book, however, we've pounded the drums many times, and we'll continue to, about the importance of being represented in these exercises. However, from a pragmatic perspective, in this week's videos, we wanted to walk through, okay, I want to sell my business. How does this actually work? What are the actual steps? What can we expect for timing? What does the audience look like? How does this thing actually function? Because it's one of those things, selling a business, that's talked about quite a bit, but the actual exercise of it's fairly opaque or not discussed, and I think can be fairly perhaps under-sophisticated for companies in the sub $10 million range, if not done correctly, and yielding lousy results as well. And so that's our thoughts. This is a real-life example of a business that we sold for an optimal outcome that we were very pleased with. And so hope the week continues to go well for everyone. Keep pushing forward. God bless. We'll see everyone next time.